Good afternoon. I'll say that one more time. Good afternoon. All right, thank you. I'm Jim Mintert, professor and director of the Purdue Center for Commercial Agriculture, and I want to thank you for attending the session this afternoon. Our session is entitled Managing Your Farm in a Volatile Market. Joining me today are my colleagues, Dr. Jason Henderson, who's a professor in ag economics and also the senior associate dean of the College of Agriculture at Purdue, Nate DeLay, who's an associate professor of ag economics at Purdue, and Michael Langemeier, who's a professor at ag economics at Purdue and also the associate director of the Center for Commercial Agriculture. For those of you that aren't familiar with the Center for Commercial Agriculture, we're a component of the Agricultural Economics Department at Purdue that's focused on developing and delivering programs targeted at people that use production agriculture as their primary source of income. So we do lots of things on the web. I'll put up the website address later. We do in-person programming as well, and obviously sessions like this. One of the things we do, we publish every month in partnership with the CME group, is the Ag Economy Barometer. The Ag Economy Barometer is a monthly survey of farmers across the nation, targeted towards commercial scale producers. We focus on people that have a estimated gross farm income of $500,000 and up, and we pose a series of questions to those folks every month. It's not the same people every month, but we hold the demographics of the people we talk to constant every month. So in terms of the mix of corn, soybean, wheat, cotton producers, as well as beef, dairy, and pork producers stays the same or approximately the same every month. So a pretty good measure of what people are thinking about. And I want to share a few of those results with you. Before we get started, as a means of kind of collecting questions, we're going to encourage you to use an app called Pigeonhole. And if you scan that QR code with your phone, you'll be able to access the site, submit questions. Asa in the back of the room, Asa Good, our senior associate managing director, is going to help us kind of curate those questions and kind of keep track of those as we go through the session. So I'll leave that up for just a second so you can get that on your phone. And then we'll try and answer those questions. I'm guessing some of you might have some questions we don't know the answers to, but we'll at least talk about it. So, everybody got that operational that's trying? Looks like a couple of people still shooting at it. So, the Ag Economy Barometer enables us to publish a monthly survey, a monthly sentiment result for the perspective farmers across the nation have with respect to what's going on their farms, as well as the ag economy in general. And so every month we pose 5 questions at the outset of the survey to them, and we use that to develop the index known as the Ag Economy Barometer. So this is a sentiment index that measures farmer sentiment. We started the survey back in the fall of 15, and so we've got data from the fourth quarter of 15 forward. And you can see how sentiment among farmers has fluctuated over that time frame. If you look at today versus a year ago, sentiment was pretty darn positive, a reading of 165. This month, just results released here in the 1st of March, 125. So the puzzling thing about that is that for many of us, 2021 was a very good income year, and despite that, farmer sentiment declined pretty dramatically, right? No big surprise why it was very positive a year ago, but the surprise is the weakness in sentiment we've seen over the last 12 months. We take the results of those first 5 questions and we decompose them into 2 sub-indices, an index of current conditions and an index of future expectations. And both of those indices have declined over the last 12 months, but the index of current conditions has fallen twice as rapidly as the index of future expectations. Again, a little bit of a surprise given the strength that we saw in farm income in 2021. So the question really is about why were people becoming as negative with respect to sentiment on their farming operations and on the ag economy over the last 12 months. And we think a tremendous amount of that is tied to the uncertainty that we've been experiencing in the ag sector. One of the questions we asked as an extra question this last month was, looking ahead to next year, what are your biggest concerns for your farming operation? And notice on the right-hand side of that chart, the 3 most common responses we received. Number 1, higher input costs were the number 1 concern. Number 2 was lower output prices. And number 3 was environmental policy. And I want you to think about that for just a second. If we had done this same question in prior years, what do you think the responses might have been relative to the responses we have here? It's very unusual that we would have that much uncertainty about input costs, don't you think? More commonly, we would have received responses that said that lower output prices were perhaps the biggest concern. So we've kind of flipped that a little topsy-turvy here, and this is a very unusual situation in agriculture to have this much uncertainty about input cost, coupled with the dramatic rise in input costs that's already taken place. And the environmental policy has kind of risen in some of our other survey questions in recent months. People have become more concerned over that, or especially over the last 12 to 15 months. One of the questions we ask every month is to ask people what their perspective is on farmland values. And we ask it 2 different ways. One focuses on what their outlook is 5 years into the future, and the other one looks at it over the upcoming 12 months. So the chart I'm showing you are the results in an index form for the 5-year ahead question. And as you look at the right-hand side of that slide, you can see that the readings are pretty positive, right? Even as we've had the big increase in farmland values over the last roughly 18 months or so, people remain relatively optimistic about farmland values despite the weak sentiment. So I think part of what we're picking up here in the sentiment index is how people feel about what's taking place. When people look at farmland values, they're probably looking more closely at their income statement, perhaps their balance sheet, and recognizing that there might be still some opportunities there, at least feeling that way. We did a follow-up on this last month with respect to the folks that said that they expect to see farmland values rise over the next 5 years. And we asked them, why do you expect to see farmland values rise? And this is the responses. Number 1 reason they gave us was non-farm investor demand followed by inflation, right? And in fact, I would argue that for the folks that said non-farm investor demand, part of that was probably reflective of an expectation for inflation and maybe non-farm investors in pursuing it that way. I have to say, my colleague and I, Michael Langemeyer and I, before we posed the question, we actually thought strong farm cash flows and low interest rates would be a little higher on the ranking there than what it turned out to be. But as you think about it, what's taken place there is we've been in an environment where stable investments like bonds and certificates of deposits have produced very low returns, and so a lot of non-farm investors are looking at another alternative investment and looking at it from that standpoint. So I guess the point I really want to leave you with there is some inflationary pressure with respect to feeding back into farmland values, and we're going to talk a little bit more about inflation in just a minute. So Michael, you've taken a look at net farm income expectations based on your work with respect to a case farm based on a corn and soybean operation here in Indiana.
Yeah, and this might be somewhat surprising to people, given the surge in input costs that we've really seen. Just to give you some perspective there, looking at 22 budgets compared to 21 corn budgets, costs are up 25%. On the soybean side, costs are up 15%. And so very large increases in input costs. Despite that, particularly since January, crop prices have really improved. And so we've looked, 2022 looks better all the time. And so 2022 doesn't look quite as good as 2021, but it compares very favorably to some of those really good years in 2007 from 2007 to 2013. Jim, when we were doing webinars back in December, 2022 looked like it was going to be about average. It looked like it was $125 per acre. This is for a case farm. That was going to be the net farm income given the prices at that time. Since then, obviously, it's increased dramatically. In fact, it's more than doubled. Now, using recent futures prices for November soybeans and December corn, we're looking at a potential return of $275 per acre. And so it's a little bit surprising to see this strength in net returns for 22.
And I guess if we want to emphasize, Michael, a dramatic change in a short span of time, and we'll talk more about that later and what that might mean in terms of how you manage your farming operation. You've taken a closer look at break-evens and the relative corn and soybean profit projections, right?
This has also changed very rapidly in the last several weeks for obvious reasons, but let me talk a little bit about this. Before Russia invaded Ukraine, soybeans actually looked like they're going to be quite profitable compared to corn. And so we were telling people a webinar or two ago, a month or two ago, that second-year soybeans, particularly in the eastern corn belt, looked like they were going to be outcompete corn in some instances. That's all changed, since Ukraine has invaded Russia, because obviously Ukraine's a large producer of corn. Corn prices have increased rather rapidly. And so what this shows you in particular is if you have a $14.50 soybeans, and so that's approximately what the price would be next fall, adjusting for a normal basis. On average productivity, for example, corn price would need to be $6.15 and above. Well, what was the corn price this morning? $6.25. So corn again compares very favorably. Looking at the high productivity, where corn is yielding 215 bushel, it will only take 596 corn. And so corn is going to be very competitive compared to soybeans. And as we've talked about many times, Jim, there's going to be a real race for acres this year. A lot of competition for acres, not only between corn and soybean, but also spring wheat and some other crops too.
Yeah, so it's been interesting these last 2 weeks to see the change in the relative position of corn futures versus soybean futures as the market has kind of recognized that we've lost access to this large Ukrainian corn supply. We've bid up corn futures prices relative to soybeans to basically stimulate some more corn acreage, which is a big change over the last few weeks. So, Jason, we started off talking a little bit about inflation with respect to farmland values. You've taken a much closer look at inflation from a longer-term perspective.
Yeah, I think as of right now, we were dealing with inflation, 7% when you include all commodities or all products or all items. It's more 6% inflation if you exclude food and energy of various different things. From my perspective, we're going to be in the short term, we're going to have higher inflation we're going to have to be worrying with. But it's just a reminder from this chart, if you take a look back, it's still not the 1970s just yet. Right? It's more of that first part where inflation surged and then it came back down and it slowed. Then it surged again. They had like 3 surges in the 1970s. I'm not going to get worried about it until you guys all start wearing plaid and polyester like you did in the 1970s, right? On that aspect. No, I think in where we're at on inflation is that there's a lot of similar dynamics to the 1970s. And in the 1970s, there was a lot of monetary stimulus that went into the market. At the same point in time, we had a lot of market forces, like a Russian grain deal, that were true market-driven, real forces that were driving inflation. And the hard part was trying to figure out what was real and what was not, what was monetary policy. And so that's the point of it, kind of where we're at today, is how much of this is really driven by monetary policy factors and how much of it is driven by real market factors that are shaping agriculture. And so when I look at, I'm going to start from the monetary policy side. When you look at monetary policy and what the Federal Reserve has done, I break it down simply looking at two lines, okay? The red line here is the printing press. This is what the Federal Reserve has added to its balance sheet. In order to buy things, it generates a printing press. It doesn't print actual dollars. It electronic debits and credits, and go through on that. You move through time, it went from $800 billion before the Great Recession, right? Now they're up almost at $9 trillion. A trillion here, a trillion there, and pretty soon you're talking about some real money. Now, it hasn't generated inflation. A lot of it has been propping up the economy, but what the Fed has been doing with all of that money is some of it goes into the economy, but some of it, they entice banks to keep it in deposits at the Federal Reserve. This is called sterilizing money. Sterilizing money so it doesn't generate inflation. And so you have to look at the difference between these two lines. What's happened this last year is that the red line, they've added another about $2 trillion in there, right? But the blue line, which is deposits held by banks, that's generally flat. That wedge has increased. Where's the money going? It's going in the economy. It's going in the housing market. It's stimulating inflation in many different ways as well. It's spurring demand, ginning up the economy. And that's the one difference that's been happening over the last year from a monetary policy side, is that the Federal Reserve has been adding money but hasn't been able to sterilize it as it has been over the last decade. So that's a monetary policy factor. What's going to happen going forward? The Fed's talked about shrinking its balance sheet, which means that red line is going to come down. They've been talking about interest rates and being more aggressive on that, of raising them over the next year. But now you have a Ukrainian war, right? Raises questions about global demand, and the Fed is kind of going, okay, what do we do? How fast do we go? Do we slow it down a little bit? Do we still raise it? And it's trying to find that, Goldilocks scenario. Not too fast, not too slow, but what's just right. And that's the hard part as they go forward. It's not just monetary policy, though. We have market forces that are really driving what's going on in inflation. And so when you look at the market, and from my time working at the Federal Reserve Bank out of Kansas City, when we talked about what was happening in inflation and trying to look at it going forward, inflation occurs when actual GDP, which is shown in the red line, starts to match and bump up against our potential. How much capacity for growth do we have in the U.S. economy? Okay. So we had turned back to the 2008 time period, and we had the red line bumping up against the darker line. That was when we had the housing boom. We were running up against our potential. Inflation was rising. Home prices were surging, right? Then we had the Great Recession. Actual GDP fell. It never caught back up to our potential until 2019. That's why we had a decade of no inflation. We weren't even close on the real side, okay? We were starting to get some inflationary pressures. The Fed was talking and started adjusting its monetary policy. It was starting to tighten. And then we had the COVID recession. And now we snapped back really quick, right? A lot faster than a lot of people expected. We're at our potential, and that's the market forces of why we have inflation. So we have it both coming from monetary policy and both coming from the market. The fundamental is the market. If you're not reaching your potential, you can pour as much money into the economy as you want. It's going to be really hard to get inflation. But when you've got a lot of monetary policy stimulus and you're at your potential, it's like pouring gasoline on fire. And that's kind of where we're at today, and what does it look like going forward on this part. Now, how do we resolve this? There's two ways off this chart. We can slow GDP, let's bring down the red line, or we start accelerating and raising potential GDP a lot faster. I don't know about you, but my preference is to increase that dark line and increase our potential GDP, expand our capacity, okay? Fundamentally, our potential GDP is based on two things: how many people we have and how productive they are when they work. That's the simple fundamentals of where we're at. And so when you look at this chart of potential GDP growth, it's not up there yet. Thanks. One of the things, break it down into the black portion of the bar, and that's our labor force participation, or not participation, that's our labor force that's actually at work that we have. That's slowing. Boomers are retiring. The Great Resignation, right? We don't have enough millennials, and now, what are we at, Gen Z coming in? We don't have enough people coming in, and I don't think we're going to be importing a lot more people anytime soon, if given current policies, okay? So all of our ability to expand our potential GDP comes from productivity. How are we going to generate more productivity out of our workforce? It's having really smart people and giving them all the latest and greatest tools to work. And that's where some of our investments and reinvestments need to focus on and doing different things. We are not like the 1970s. In the 1970s, that black bar was huge because the boomers we're graduating high school, graduating college, starting families, buying homes, buying cars, but their productivity growth was very small. How do we stimulate productivity? And I think when I look at it, we're going to have inflation, in my mind. It's going to be market forces are there, tight markets, the structure that we have, we've squeezed a lot of different costs out of the system. We are set up for higher levels of inflation from the market. And we have monetary policy at the same time as trying to stimulate what's going on. A lot of it's like the 1970s that it's set up. But how are we going to respond differently? And for me, this time, we got to focus on productivity so that we don't repeat the 1970s.
So thinking of productivity, Nate, you've been looking at productivity in the ag sector specifically.
Yeah, so picking up on those themes, we've been looking at innovations in ag tech, what that means for farm productivity, because some of those trends that Dr. Henderson just highlighted are happening in agriculture. There's a measure that we call total factor productivity, which is just the total amount of agricultural output that we can get for a given mix of inputs. And that had been climbing steadily for a long time, but in recent years, it started to plateau. So we want to know, is agriculture technology our way out of this and potentially a way to get to another, like a green revolution in agriculture? So I want to highlight two specific innovations that have taken place recently. The first one is See and Spray, the ability to target weeds using machine learning technology. That came out in 2021. And then, of course, the autonomous tractor, which was announced this year that it's going to be available later on. So we want to know, given these more recent innovations, who's going to be adopting these? How quickly can we expect them to be adopted among commercial farmers? And what does that mean for productivity going forward? So next slide, to kind of put that in context, we can look back at some other innovations that have taken place in agriculture. The first one being GPS guidance or auto steer, and the other one is variable rate technology. Both of these were more or less commercialized in the same time frame. And you can see the trend line. This is among soybean producers as of 2018, the cumulative percentage of those soybean farms that have adopted these technologies. And what you notice right away is where that line peaks out for auto steer is just under 40% of soybean farms. So despite a lot of the excitement we use to talk about agricultural technology, it's actually not as ubiquitous as it seems. So that has some lessons for us when we think about what's going to happen with autonomous tractors. Is it really going to be adopted immediately overnight by all commercial farms? The other thing you notice is that the trend lines differ by those technologies. So guidance, you can think of this as more or less out of the box. The benefits are pretty immediate once you adopt this technology. But variable rate technology involves a decision-making component by the operator. So you have to take data, information, you have to write prescriptions, and you have to use that technology as an input in the decision-making process. So that's going to shape how those technologies get adopted. So we can look at the next slide. This is looking at the differences in farm sizes by stage of adoption. So on the far right end of that graph, this is soybean farms that adopted GPS and variable rate 15 years or more ago. So these are what we would call early adopters. They were roughly within the first 10 years of those technologies being commercialized. If you look at the size of those farms compared to all the way on the left end of that graph, which includes those that haven't adopted it yet as of 2018, there are big differences in the size of those farms. So clearly the scale economies are at play here. And when I say scale economies, I mean these are technologies that are advantageous to be used over a lot of acreage, right? It makes the per unit cost of operating that technology lower. You can spread out that high investment cost. And the other thing I would point out is the difference in that trend between guidance and variable rate. So the one that is the most pronounced in terms of scale differences is guidance, right? The difference between the non-adopters or the late adopters and the early adopters in terms of scale is much more dramatic than it is for VRT. So if we go to the next graph, now I'm comparing productivity across those adoption stages. So on the far end here, this is average soybean yield among farms that adopted these technologies 15 or more years ago, versus all the way on the left, these are the farms' yields that haven't yet adopted those technologies. And again, the story is pretty clear, right? The ones that were early adopters, that are innovative on the cutting edge, much more productive. But then when you compare those two lines to each other, the story kind of reverses. Now it's VRT that has the most dramatic difference in soybean yields from non-adopters to early adopters than it is for guidance. So there's a productivity story now. The ones that adopted VRT earliest were more productive in terms of average yields than the late adopters or the non-adopters. So guidance seems to be a scale economy story. VRT, it seems to be productivity. And as Dr. Henderson pointed out when we were talking earlier, it could be that VRT has sort of a cumulative effect. The early gains that are enjoyed by those early adopters in terms of productivity kind of avalanche, and you grow the overall productivity of the farm as time goes on. And there's a learning by doing component with VRT that really isn't there with guidance. So economists talk a lot about adjustment costs when we think about technology adoption. That's the cost of the farm of bringing on a new technology, revamping your production process, getting the most out of that new technology, and that's going to be a bigger component in VRT than it is for guidance, right? Because there's a learning process there and how you apply that technology best. So we go to the next slide. We're looking now at, instead of just hard equipment technology, we're looking at data usage. So this is corn farms as of 2016. This is showing you farms that use data through an ag tech platform, website, data through a mobile device, or that use their data on a computer. And again, the scale story just comes through very clearly. All of the, or most of the farms that are on that larger end of the production scale are using computers, many of whom are also using mobile devices and ag tech technology. You look down at the lower scale, much lower adoption rates there. So this is just kind of reinforcing the fact that farms that use these technologies, that integrate them with data, going forward, they're going to be the larger farms. So you'll see that as consolidation accelerates or continues, there's going to be a lot more technology usage among the typical farm. So kind of stepping back and asking the question, what does this mean going forward? I highlight the difference between scale economies, which I already mentioned. That's the ability to reduce your per unit cost as you grow in output, right? But there's also scope economies. So when the tractor came out in the early 1900s, it was really only useful for wheat production regions because it didn't have an adjustable axle. So it didn't work for row crop production. You couldn't change it based on the width of your crops. When that technology caught up to be useful in row crop production, that's when adoption really took off for the tractor. So there's a scale economies component, but there's also that scope economies component. So I put up the headline of John Deere See and Spray technology. At the moment, that is only applied to green on brown, so residual herbicides for post-fallow, right? But they're going to be coming out with, I think next year, a green on green technology that is useful for non-residuals, right? So that's an additional use for that technology that makes it more overall useful. If you look at autonomous tractors right now, it's for tillage, but that's going to catch up. More field operations are going to be made autonomous, things like planting and harvesting. So in the future, those uses will grow and therefore the adoption will increase. The other consideration is the labor side. So particularly in ag tech, we ask the question, how much labor savings can we get? How much farm workers are we going to displace? What is the trade-off there? And I think the better way to think about it is as a labor augmenting process. So ag tech, like autonomous equipment, will change how much the operator spends on regular field work, right? It's going to change the mix of their weekly hours. So they're going to move from more of an operating position to being more of a manager, right? It's going to increase the amount of time that they spend managing the production process overall. And it's going to change the labor needs of the typical farm. You may not need somebody in the grain bin, for example, just driving along, but you might need more outside help processing and using data, So thinking about this in terms of labor augmenting. The last point I would make is these technologies need to be interoperable. So interoperability meaning your hard technologies need to integrate with your data technologies. All of this stuff has to communicate with each other in order for you to really achieve the greatest benefits from it. But it also means interoperability in terms of you as the manager. You have to be able to integrate these different technologies and get the most out of them yourself. So going forward, I think those are 3 things to be on the lookout for.
All right. Thanks, Nate. So when we proposed the title of this session last summer, I have to admit we didn't exactly know that things were going to be as volatile as they have been, but we had some ideas that we were facing an unusual amount of volatility. And so our challenge today is to think a little bit about how can you deal with volatility, because it's pretty clear we're going to be in a volatile situation going forward for certainly the rest of 22, but I would argue probably for the next several years. And so let's think about that a little bit. Michael, you've given this a lot of thought with respect to how we might come up with a systematic approach to dealing with volatility.
Yes, scenario planning is something that's widely used in businesses, particularly large businesses, and it's something that we can use in agriculture. And when you're using scenarios, these are not necessarily predictions. You're not saying, well, I think there's going to be 750 corn, thus I'm going to do X, Y, and Z. Instead, you're developing several alternative scenarios or several alternatives, and then you're seeing how all this volatility plays out. And the advantage of developing these scenarios well ahead of time is think about how different it would be, your decisions would be if you had $5 corn next fall and $7.50 corn. Under the $5 corn, you may not buy any assets. You don't have, your working capital might go down. You don't have that down payment available to buy land. You might not be able to bring a younger family generation into the operation. $7.50 corn, completely reverse. And so that's the idea here, to make better decisions about asset purchases, but also to make better decisions, plan B, if you will, about repaying debt. Under the $5 corn scenario again, you may have difficulty repaying debt, whereas in the $7.50 corn scenario, not only can I repay debt, I can probably buy some assets. And so in a volatile environment, there's just a lot of advantages to looking at 2 or 3 different scenarios and then see which of those plays out over time so you're ready to make decisions. One of the things that Nate talked about is the technology is becoming more management intensive. It's the same with risk management. There's so much more of a managerial element to risk management, and so that's what we're trying to do with these scenarios. Is we're trying to develop some cases or some scenarios and plan accordingly.
So, Michael, you think about working with ag lenders. Ag lenders like to talk about stress testing. Stress testing is a form of scenario analysis, but we're suggesting something a little broader than that, because stress testing emphasizes one level of scenario, namely the downside risk, right? We're suggesting you need to think about what would happen on the upside as well. So it's important to look at what would happen if things go perhaps worse than you think is most likely, and things go better than what you think is most likely, as well as that most likely scenario, and use that range to maybe make some decisions. To maybe put a little more confidence in that, let's just kind of look at what the corn market currently thinks the range of possibilities are for corn. So this is based on a price distribution tool that's available from the University of Illinois' FarmDoc team. And what it does is it takes all the information that's out there today, basically a combination of corn futures prices as well as option premiums and volatility, to try and use a model behind that to assess the probability of prices ultimately winding up at various price levels. And so the 50% mark is about where we're at today, right? I just did this morning. So 625 is kind of the mean approach, the mean value, the most likely outcome, I guess you could view it as that way. But notice the positive probabilities out there for some relatively low prices and the positive probabilities for some very high prices for corn. And that gives you kind of a range of ideas with respect to, when you're thinking about scenarios, well, what kind of prices might I use? This price distribution approach can give you some ideas with respect to identifying not only the most likely, which is that midpoint, but rather the extremes that you want to look at. In other words, if you think about it from a statistical perspective, the tails of the distribution of prices. And let's just think about that a little bit. So, Michael, you considered a scenario planning exercise for 2022.
Yeah, I typically use the 25%, 50%, and 75%. I don't like to go to the really small probabilities. You notice there was one probability where corn would be under $4, but that's highly unlikely, and so focus on things that have a little more probability. And so here would be the way I would look at this. How would our marketing plan be affected? How would working capital be affected? How would asset purchases be affected if we had 520 corn or below, 625 corn, and our corn price is 750 and above? And I would develop budgets. I would develop cash flows. So we can look at what happens to working capital. We can look at what happens to our ability to pay debt under each of these scenarios. I think that's a very useful exercise. And again, thinking ahead about what you might do under these different scenarios is very helpful. It allows you to really think about, well, if this happens, I'm going to do A, B, and C. In particular, I think it's important for working capital, looking to see if your working capital is deteriorated, but also asset purchases. Under the 750 corn, you're probably much more likely to buy some more iron than you would be under the 520 corn.
And so, Michael, we've kind of emphasized the price aspect to that, but you could use scenario analysis in other ways, right? You could think about variations in interest rates. You could think about variations in maybe enterprise mix. So there's lots of different ways you could use it, but the key point is to look at several different scenarios. A lot of times in agriculture, and actually in business in general, we like to focus on what we think is going to happen. That's our so-called most likely scenario. But the reality is we're not very good at forecasting, and so scenario analysis is about recognizing that we're not that good at forecasting, that we are reasonably good at identifying what those extremes might be, and looking at how the outcomes might vary under those different scenarios. And that allows you to make some better decisions with respect to risk management, obviously, but also with respect to the other aspects of your business. So let's talk a little bit here at the conclusion, and probably if you haven't already done so, typing in some questions for us to continue the discussion. Let's kind of wrap up here by talking about what we think the future is going to look like. And Jason, I'm going to start with you with respect to what's going on and likely to happen with inflation.
So I think in my end, it's going to be higher levels of inflation. We have market forces, you have monetary policy doing that. But it also kind of reminds me of when I first started my career at the Federal Reserve, a north central Iowa corn farmer pulled me aside at a meeting and he said, "Jason, I loved your presentation, but remember one thing, business is about people." And so for me, I think inflation going forward is going to be about demographics. And while I talked about the U.S. and our demographics of boomers and Gen X and not having enough people, it's the same way globally. China has gotten rid of the one-child policy. And if a country of 1+ billion people doesn't think they have enough people, we got a demographic problem that's global, not just the United States. And that's going to put some pressure globally, I think, on inflation if we don't have enough people on doing different things to grow the economy. The other part of it, I think, from your perspective, is comparison to the 1970s. When you get higher levels of inflation, you got to think about how you're going to finance your investments. In the 1970s, how many of you remember hearing fence row to fence row? Right? And use debt to do it because this is the cheapest money you'll ever see in your lifetime. For a short period of time. For a short period of time. So I think when you think about it, we're going to have some higher levels of inflation, and if there's a 25% chance that corn's going to be above 750, some of you are probably looking at, ooh, I'm going to have some revenue, what am I going to do with it? But how long is that going to last, and how long, how are you going to finance some of those things that happen out there? How much debt you're going to use, and what's the longevity of it? And so that's some of the things I think you have to think about in terms of higher inflation from that standpoint of what does it look like going forward.
So what about the value and supply chains that we've built up really over the last several decades? Our perspective is we're going to probably see a renewed emphasis on reliability for obvious reasons based on what's happened the last couple of years and especially just the last few months. Maybe a little less emphasis on the cost side, right?
Yeah.
How's that going to play out?
I'll throw in my 2 cents.
Okay.
You can ask others. My 2 cents are, I think there's going to be more focus on reliability, not so much on cost. We've gone decades, right, where the American farmer, our job was to produce food at the cheapest amount for our consumers. I think that's going to be a challenge going forward because we can produce cheap food, but if we don't have food at the grocery store, and remember today, we don't want just a roast. We want a 2-pound roast that's been marinated and it's ready and quick to serve and all those things and ready to go, or all these other things. And I think over the last year with COVID and our supply constraint issues, when we run out of toilet paper, we have a more focus on reliability of products being there when we want it. And so while we've stripped out a lot of the cost through just-in-time inventory systems and going global, are we going to be rethinking our globalization and bringing some production back home and thinking about having a little bit of spare capacity or float so that we have products on the shelf for our consumers when they want it, of doing different things? And the other aspect of it is, I think we have to ask our question over time is, what's the new plateau for commodity prices? In the 1970s and 80s, corn was $2, plus or minus a dime, right? Then we had ethanol. It was kind of like $4, plus or minus a quarter. Maybe, we have some price constraints, we get $7 in there, but it's in there. Is $4 the new plateau? Is it 7? I think it comes down to what our costs are. What's our cost structure? I think that's going to drive it. But I think that's a question that we're in the middle of, and I don't have an answer to, but that's what we got to figure out. Is this a short-term blip in terms of our prices, or are we starting to put a base on a new plateau in the commodity markets?
So I'm going to follow Jason because he and I don't exactly agree on this one. Jason comes out on the side of reliability, which is what all the discussion has been here lately, is going to be the new emphasis over cost. And I'm going to say that there's going to be some increased emphasis on reliability, but usually what happens is when the reliability starts to maybe fade from concerns, what do we really focus on? It's cost. Right? So I don't see quite as much change there with respect to the supply chain aspect maybe as Jason does, although I'm going to concede there's going to be some changes, more so on the manufacturing side. I don't see as much change on the agricultural side, and stated another way. I don't think we're going to do things like move away from very efficient, low-cost operations that we've established over the years on the ag side. Michael?
Yeah, let's talk about cost of production a little bit. In about a year ago, looking at the 21 crop, when we were developing budgets for the 21 crop, there was a lot of people out there that were going to produce corn for under $4 per bushel. Is there anybody that's going to produce corn for under $4 a bushel this year? Probably not. If there is, there are not very many. And so I want to answer the question a little bit. I won't answer directly the plateau question, but I don't think the cost of production right now for the high productivity is $5.10. And that might be a little bit low. I might be adjusting that upward. It seems like I adjust these upward over time because our cost structure is increasing because of this inflation. Is it going to go back to $4 in 1 or 2 years? I don't think so. With the inflation in the economy and some of the bottlenecks we're seeing out of the Ukraine-Russia dispute, potash fertilizer, for example, I just don't see. I don't think we're going back to $4 corn anytime soon. And so I would vote on that cost of production is going to stay 5 or slightly above, at least for the foreseeable future.
And that'd be consistent with our history because we know from history that production costs tend to be sticky, right? And they can come down. We have some evidence of that. We're not saying they never come down. We have evidence of that, but they tend to be sticky. So once they go up, it's difficult to drive them down and certainly takes several years. On the technology side, Nate, tell us a little bit about what you think with respect to where we're headed on technology.
I think it's going to be a series of gradual increases in productivity that don't change farming overnight, but 20, 30 years down the line, it looks quite a bit different. If you look at the productivity gains that we've estimated based on farms that adopt these technologies early rather than later, they tend to be small. They tend to be larger when you aggregate them across a lot of acreage. So that's going to favor larger operations. Right? If you can accrue those or aggregate those benefits across a lot of production, it's going to have a big impact. But I mean, I go back to how the tractor was adopted, and it took 40, 50 years before that technology fully replaced draft animals. So it's important to kind of keep that in context when we talk about these new innovations. It won't happen overnight, but it will happen, and it's not entirely clear that something like autonomous would fully replace existing technologies. We've seen that actually there's a bit of saturation when it comes to some of these precision technologies where a certain subset of farmers, typically the largest ones, will adopt, and there will be those that eventually just don't.
So one of the questions that we usually get about this time, Nate, is will technology be scale neutral, or will it favor, over long periods of time, larger operations?
It depends on the technology, I think. There are certain innovations that are much less scale neutral than others. There's been, when it comes to autonomous, for example, there's a bit of a debate about whether that really does favor large operations, or if it's smaller fields, more irregularly shaped fields that could benefit from smaller autonomous equipment that, you know, it may be smaller equipment, but more of them.
So I'm going to go to Asa. You got a question for us from the audience?
I got a handful of questions from
All right.
the audience. So one that has come in, what is the relationship between inflation and interest rates? At 8% inflation, what would we expect operating loan and mortgage rates to be?
Jason?
So as interest rates rise, or as inflation rises, so do interest rates. And there's a lot of different factors that are in there. I usually, so if you get interest rates rise, I always look at kind of what the Fed response is going to be. And Fed does short-term interest rates, so right now they're just above 0. But if they raise it like 1 or 2 percentage points, then you have to usually add on about 4 to 5 to get that market rate that farmers would produce or have to deal with as they go forward. So that's kind of where it's going to have. I just don't think the Fed is, I mean, I don't think they're going to move, my personal opinion is I don't think they're going to move really, really fast given some of the uncertainty that's happening right now, but I think they're going to start inching it up of going forward because when it comes to interest rate policy, slow and steady wins the race, and the Fed has always wanted to be a market stabilizer, not a market disruptor.
And maybe a corollary to that, Jason, I think from a very long-run perspective, when you think about inflation relative to interest rates, you think about in the inflation rate plus a real component, but that doesn't have to happen in the short run, right?
No, that's long run. So if long run, if you look at the Fed target, they want inflation to be 2%, right? And when they get a long run target of a 2% inflation rate, oftentimes when you look at the long run interest rate that's out there, it's usually about 6 to 8. So you're looking at 4 to 6, percent difference on that of kind of what they're at from inflation, and then on top of that real part.
And then getting back to that question, if inflation stabilized at 8%, which I think maybe is where that question was coming from, if we had 8% inflation for an extended period of time, we'd be looking at double-digit interest rates, correct?
It would be really high interest rates, yeah. It would probably be double-digit interest rates.
It'd probably be like 10 or 11%, right?
Yeah.
Because you would take that 8% and then add on a real, right?
And then you add on a real, usually around that 4 to 6%. That's what you're talking.
But I want to emphasize that would be more of a long-run situation, not short-run, right?
That would be long run. So, because if you go back to the chart that I had on inflation, in the 70s it was up 7% and then it was down. And then it went back up and then it was down. And it took 3 surges, right, to get that to moving in there. In the 80s it was different. It was flatter, but it was elevated at that 5 to 6%, which is above what the long term of where the Fed wants to go and driving it. So I think if we get inflation, I think it's going to be more of like the 70s versus the 80s scenario, where you get inflation will spike up, but it'll come down, you'll get a breather, and then it'll spike again. So that's why I was talking about the 70s. If I'm going to look at just the decades of how it flows, there's going to be a lot more volatility, right? And not we hit it and it's a plateau if we're growing 8% per year for a decade.
Asa, you got another one.
I do. I'm going to hit the inflation one more time. So how many months of higher inflation do we have to have before the Fed stops calling it transitory inflation?
So the transitory story, it really comes down to, if you go back to the 70s scenario, that picture again of where it is. When they call it transitory, it means it goes up and they think it's going to come down. It's more about the composition of where the inflation is emerging from and why they think it's transitory. Because there's a higher inflation in food and energy is moving higher than the inflation of all other goods, they think it's transitory because inflation in food and energy tends to go up and down a lot more than the cost of goods and other parts of the economy of what we buy. So that's why they're using the word transitory, because they're thinking it's coming from that commodity side, which tends to be more volatile and up and down. They'll stop using the word transitory when it hits the wages, and our wages really start going, and not just a one-time December bonus at Christmas, but it's more of our wage rates start rising, because that turns into usually continuous long-term spending, right? Because what's the definition of American consumer? A person that's more than willing to spend money that they don't have. And so when they get a little bit money, what do they go do? They buy more stuff than they really don't have the money to have, and they use debt to do it. So when you get that wage increase, that's where they're looking at for that long-term spending, and that's when they'll stop using that word transitory.
And they have kind of backed away a little bit. I think some of the recent comments from Fed Chairman Powell, he's kind of quit using the word transitory, at least obliquely.
Yeah, he has. And at certain points in time, this is a little story from the New York Fed president, we had the last food price inflation. So was talking about the short-term transitory nature of food prices and all that. And I think a person in the crowd stood up and he says, "It's great. I understand it's coming from food, but I can't eat my iPad. So let's start talking about inflation and what it really means to us." So.
Asa, you've got some more, I think.
I do. Okay. Do you believe management will trump emotions of the past? Will we stop putting fertilizer on based on economic return or emotion that's too expensive, that it is too expensive?
Could you repeat that? I didn't quite catch that.
Yeah, I would be happy to. Do you believe management will trump emotions of the past? Will we stop putting fertilizer on based on economic return or emotion that it's too expensive?
That's a classic farm management question for Dr. Langemeyer, I can tell.
Yeah, I want to answer that in a couple different ways. First of all, we had an Ag Economy Barometer question on this issue, and I believe, Jim, that 55 to 60% were going to use a nitrogen rate similar to last year, but there was about 30% indicated they were going to reduce their nitrogen rate, which would be more of an economic response. But one of the questions we get, and I don't have an answer for that, is we hear people saying, well, I think I'm going to plant more soybeans because the relative cost of soybeans is lower and the cost hasn't went up as much. We would never recommend doing that, obviously. You need to look at the profitability of both. And even though it costs $1,100 to put corn in the ground, if corn's going to be $650, you plant corn. But we have heard conversations related to that. I know you faced that too, Jim, where people say, well, corn is going to be so expensive to put in the ground. I really think most people are going to look at profit when they make that corn versus soybean decision.
Yeah, you get into lots of issues there with respect to long-run profitability versus short-run, right? So a lot of people, when we've done in-person meetings across the state of Indiana, we've asked, both of us have been asking this question of people in the audience. And, the majority of people are telling us they're pretty much sticking with their standard crop rotation because they're taking kind of a longer run view as opposed to a one year view of profitability. The other thing with respect to fertilizer, which is really interesting, is this year, probably more than any year in my career, we've got more variability in the cost that people have paid or are incurring to put in a crop than, truthfully, we've ever seen. And it depends on when you bought the inputs, right? So many people were able to lock in a chunk of their fertilizer last fall, or even in some cases maybe late last summer, at substantially lower rates than what we're looking at now. And their decision-making process was different based on the fact that they had different costs. So I think our answer is, we think most people are looking at economic returns, but you can get into some debates on individual operations, right? Other ones, Asa?
Yeah. So if we stay at the higher end of the price range, is there a point where you can have too much working capital? Or what ratio to overall gross revenue do you start losing benefit or benefits trail off?
That really depends on what opportunities the farm has. I mean, I can't make it, I can't state it any more simply than that. It depends on how old your equipment is. Does that equipment need to be updated? Obviously, that would be a good use of working capital to make sure that the farm remains productive. It's particularly some of this precision agriculture technology. If you haven't been able to adopt in some of that, take a strong look at that. So it really depends. I mean, we indicate that something over 35% working capital to gross revenue is a pretty good ratio. But should you have over 100%? Not necessarily. If you've got some opportunities out there to buy some assets that would increase your productivity, maybe to bring someone else into the business that can take over some specific management responsibilities, that certainly should be something that you need to be considered. So yes, there is such a thing as too much working capital and not putting working capital to use.
So, Michael, I think one of the questions we ask on the Ag Economy Barometer every year is we ask people about their growth rate plans over the upcoming, I think, 5 years. And we ask people what they're thinking about. And we've had a relatively high percentage of people say they're either going to retire or they have no plans to grow in the next 5 years. In fact, on the most recent survey just a month ago, I think it was a little over half, 53% of the people in the survey said they were in one of those two categories. And the biggest one was, I'm not going to grow at all. And if you're going to be sustainable over time in this industry, you have to grow, right? That's pretty unequivocal. So how should you be allocating your working capital? Well, one of the things you got to think about is, where is this farm going down the road? If you're planning on being in business 5, 10, 15 years from now, you're going to have to allocate your working capital in a way that enables your farm to grow over time, not necessarily in 1 year, but over time, you've got to have that growth rate factor. Otherwise, you're going to fall behind and be one of those farms that Nate's talking about, kind of hanging back, being a non-adopter. And those farms over time become less and less competitive. So, Asa, other questions?
No, and I think you're running up on the end of our time. So
All
if
right.
you want to pop up your closing comments.
I will wrap that up. So we do lots of things at the Center for Commercial Agriculture. We hope you kind of tap into some of those in the future. Our website is purdue.edu/commercialag. We do Michael Langemeyer and I, along with a colleague, Nathan Thompson, do a monthly webinar following the updates on the World Ag Supply Demand estimates. We have a crop basis tool, which enables you to track what's going on with crop basis, not just in Indiana, but we cover Indiana, Illinois, Michigan, and Ohio. So those 4 states averaged across crop reporting districts, which is a good way to kind of keep up with that. And we do a host of other things on the web, so I'd encourage you to tap into that. I guess we just recorded a podcast this morning, Michael, which will probably be up on the web here later this afternoon. So we appreciate the opportunity to visit with you. We're looking forward to visiting with some of you individually. We'll be around at the booth on the trade show floor this afternoon if you want to talk to us individually or right after this program. And
Booth
hope to see you on the web. And
Booth number is 5156. So not far from John Deere if you're looking for a big one to locate.
All right. And I think someone from Commodity Classic perhaps has already passed out the evaluation surveys. If they haven't, you should be able to grab one. There's also a QR code out in the hallway, and I think it's just 3 questions. They do look at the surveys in terms of planning the program for next year. So with that, appreciate the opportunity. On behalf of the panelists, I really appreciate their contributions. Thank you for joining us today.